We certainly see it today in market prices and in everything that's happening. There are three, sometimes maybe we could stretch that to five, big things that are happening, and they are reflected in market prices, and the dynamics behind them and their change will be reflected in changes in market prices. And those three big ones are, first, that which is happening with money and credit. In other words, when you spend a lot more money than you earn, and the government does that, that means that a lot of money is printed and it moves its way through the system in a way that is reflected in market prices. And so that is what is happening now. The second is the very large internal conflicts that we're having that are due to wealth gaps, political gaps, and so on, that influence the left and the right and the dynamic between them. That affects tax policies, that affects capital flows and the like, and they're reflected in market prices and will change as those circumstances change. And the third big influence is the rise of a great power, China, to challenge the existing leading power and the existing world order. And that is being reflected in market prices, but will be reflected more as those circumstances change. The other two that have been reflected through history, and I didn't have a full appreciation of until I studied the last 500 years of history, those two are technology and inventiveness changes. We're accelerating the rate at which they are occurring, and that adaptability and change is affecting our lives in big ways. So you cannot ignore the technologically and inventiveness changes. And the fifth are acts of nature. You know, the one thing that was interesting to me when I studied the last 500 years of history is that acts of nature, and they could be climate related, droughts and floods and pandemics, had cost more lives and toppled more civilizations than anything else, including wars. So they are something that comes along irregularly. You know, when you have the pandemic or the drought or that event that comes along once in 100 years or so, they have had big effects too. So pandemic is a reminder of those. But those are the drivers, and they will remain the main drivers. And as they change, prices will continue to change. I think you have to look at the dynamic behind those prices, and I think I would look at them a bit differently. Regarding the dynamic behind those prices, it is that we are spending more than we are earning by a lot, individuals and the country as a whole, and that we need money, partially because of the political issues, partially for all the reasons that you know. So a lot of debt is being created that is also producing the need for a lot of money. And as a result of that, we have very negative real interest rates. Real interest rates of short-term interest rates are significantly negative, and even bond yields, real bond yields, are over 100 basis points negative. And so when one looks at the return of owning those bonds, that is a very bad return. It means that if you save in those assets and you put it away, that you will lose buying power at probably a rate of 3 to 5% per year. We can guess what inflation is, and we can talk about that, but you will lose that, and that tax on your buying power makes one not want to be saving in those assets. It makes one want to borrow in those assets, and the availability of credit and that set of circumstances drives money into other assets, and those assets are investment assets as well as goods and services. And so what we see now is that stocks are not expensive, not very expensive, maybe a little bit more so than normal, relative to bonds, which are very expensive, but still not expensive in relation to cash. And so they are all having expected returns that are comparatively low, and we have an inflationary period. So it's very important to understand the paradigm that we're in. and how that dynamic works. And so as the inflation pressures become an issue and we have relatively, let's say, stronger growth, those things will start to change. And so the big question that the markets look at is how will that change? As a result, will the Federal Reserve and other central banks begin to tighten monetary policy? Because these things will change. And what will tax policies be and the like? And those things will affect market prices going forward. It's unsustainable. There's always, throughout history, a debtor and a creditor. And there's always, throughout history, the ability to create demand by creating debt and by creating money. And then there become clear preferences for doing one or the other. There are environments like the late 1970s when Federal Reserve Chairman Paul Volcker tightened money and wanted to make it good to save and bad to borrow and have credit. That set of circumstances was caused, and that action was caused by things that happened before it, high real interest rates and the like, and that produced the environment that we had, largely the disinflationary environment that followed. Similarly, the 1960s led to the 1970s. The 60s had too much debt creation due to war and Vietnam and what we call guns and butters policies that were spending more than we were earning. And that led to the necessity in 1971 for the President of the United States to acknowledge that they would no longer be able to pay the dollar claims in gold and to default on the gold claim and to devalue the exchange rate and to devalue the dollar, which led to the 1970s, inflation and so on. So there are always, all through history, the dynamic in which there are high real interest rates and it pays to be a saver for some times. And there are times when there are very, very low real interest rates and the need to create a lot of money and credit, and it pays to have assets, the opposite side of assets, positioned in the opposite way. And that's been true throughout history. And that's the main driver. So I think when we look forward, we can use those as guides to what's likely to happen in the way of excess return. It's in fact the way the system works. In other words, investors, borrowers and lenders look at the relative expected returns of cash, bonds, and other asset classes and move their money between those things based on the relative pricing. And that's why, for example, when there is a rise in interest rates, a tightening of monetary policy, and short-term interest rates rise relative to longer-term interest rates, so the yield curve begins to flatten and so on, that we see that there's a slowing in the economy and a slowing in capital availability, lending, long-term lending. There's a shift to saving, and as a result, there's a slowing of the economy. That's, to me, how the system works.